Hey guys, thank you. A little bit of background about myself. Started my career in M&A banking, then went on to private equity. Now I'm taking a more entrepreneurial track like many of you. So early on my journey there, but it's been a fun ride so far. So I'm actually going to have each of the panelists introduce themselves, I think. Each one, just give a short bio.
Hey, everybody. I'm John Goldasich. I'm with a firm called Arlington Capital Advisors. We're an investment bank, so we're not investors. We're not operators. We all have different backgrounds, but mostly finance at our firm. Our job is to be advocates for franchisors, for business owners when they approach the market. So we advise companies on mergers and acquisitions and raising capital. Most of the time that capital is equity, but we also have a debt capital markets practice as well. And we do a lot in the franchising space. I do want to address the elephant in the room though, which is red. I've got on a black vest. So if you were here in the morning, there was a lot of black vests, so I've got the black vest on.
Hello, I'm David Barr, past chairman of International Franchise Association. Started my career in the finance world way back in 1986. Then went on to PepsiCo, more specifically Pizza Hut. Then became the CEO of Great American Cookies. Sold that business in 1998 and became, for lack of a better term, an entrepreneur. Really have taken a variety of tracks. One, as a franchisee, have put together multi-unit franchise platforms as a franchisee. As a franchisor, I sit on board of directors or co-invest with a variety of private equity firms and sit on the boards of some of their respective companies. In addition, John Rocci and I created the platform called FranWorth. Approximately 6 years ago. We work with franchise entrepreneurs in growing their brands. We usually take minority investments in those positions and then accelerate growth much like horsepower. So that's a little bit about myself. Currently, I would say primarily focused in food, fitness, health and beauty. Thank you.
Hi, everyone. I'm Steve O'Hara. I'm a vice president with the Riverside company. We are a private equity firm, global reach, and we also do a lot in franchising. We'll make minority investments, majority investments in businesses from 1 million enterprise value up to 400 million in enterprise value. And over the course of our 30-plus year history, we've invested in 40-plus concepts across 4 continents, and anything from home services, B2B services, education, QSR, healthcare, a dating site. So the whole range of different concepts. And most notably, I think we're known for our neighborly investment. So we helped take the Dwyer Group, what it used to be called at the time, private back in 2003, and was a 3-time investor.
Awesome. A lot of experience. So we can tailor this to the room. I'd love to get a show of hands here. And so who here is a franchisee? Okay. Who's a franchisor? Okay. Who is a supplier? We got a pretty good mix. Okay. I'm also going to ask who of their respective companies, who's at a owner level or CEO level? Most. And how many are right below them in C-suite or franchising or marketing, finance? Okay. And then last question, who has had intimate working relationship with private equity in the past? All right. Hopefully the rest of you will learn something here, and let's kick it off. Steve, would love for you to talk about just M&A in the workplace now. What are you seeing in terms of the trends? Is there more M&A activity, less? How does it relate to franchising, and sort of an open-ended question.
Sure. So I think the M&A market and franchisors have been very active the past couple of years. I think a lot of that is we, as investors, we like capital-efficient businesses, we like high-margin businesses, and we love recurring revenue. And franchising has all of that. And I think there's certainly some comparisons that you can make to the SaaS software world and franchising, where we can price businesses off of recurring revenue in the same way that software investors price off subscription revenue. So I think that's added to it, and I think you're seeing dedicated franchise-oriented private equity firms pop up. You're seeing the traditional funds that have invested in franchisors over the years stay active or be more active, and then you have some other folks who have not had franchise experience jump in because they love the business model. And then you also have private equity-backed platforms that are acquisitive from an add-on acquisition standpoint. We've seen anywhere from 60-plus franchisor platforms trade in the past couple of years. So I think it boils down to capital efficient and recurring revenue. And then I guess the other point of it is we see some of these high-profile deals like a Neighborly trade at high multiples, and as investors, we hope that we can get that exit at some point and benefit our limited partner investors, also benefit the management teams that invest alongside of us.
John, anything to add, or?
No, that's it. That's spot on. If you take a step back and just think from a macroeconomic standpoint, private equity is driven by the capital that's provided to them from pension funds and endowments. A state teacher's pension fund or an endowment, Harvard University. And just a quick history lesson, if you look at the last 10 years, there's been a massive reallocation of capital from the bond market, from fixed income, where interest rates have been low and where there hasn't been a lot of yield, into private equity. So a practical illustration would be Harvard's endowment. So in 2008, Harvard's endowment was $20 billion, and they had a 10% allocation to private equity. Now Harvard's endowment is $50 billion, and they have a 30% allocation to private equity. And so there's been a massive reallocation of institutional capital into this asset class, which means that funds are getting raised with more velocity. They're larger, and they're looking for yield in a lot of different areas. And so when Steve talks about what is appealing from a private equity standpoint with franchising, it also, you got to think about the bigger picture of where this capital is coming from and why it's trying to chase yield.
Perfect. And so taking a step back here, I also just want to maybe add a little color. So private equity, people hear private equity, they probably think of the Riversides of the world, and they hear buying the Dwyer Group, right, and exiting, and these financial companies buying franchisors, building them up and selling. But what is really private equity, right? So private equity in its baseline form is a group, a team who takes on capital from private investors or pension funds or universities and allocates that capital across a multitude of companies. Generally, it doesn't have to be a multitude of companies, but why is it generally a multitude of companies? It's to make sure that you are allocating your risk and rewards across the portfolio so that you have some home runs, right? And you're going to have some dogs. Every 10 investments isn't going to be a home run. And so what we're here talking about today are these investment arms, investment vehicles, are these people who go and invest across not just franchising, but the whole marketplace.
I might add, I think we could, for purposes of this room, also think of a broader scope. Mm-hmm. Private equity has become semantics for a type of fund that Ryan just described. I think you could think more broadly of private capital, right? So there's public capital that being stock market, NASDAQ, New York Stock Exchange, and the like. And then there's private capital, and that capital can come in different forms. There's now a sliver that's generally named private equity. If you go back to when John and I started our career, private equity could probably even denote high net worth individuals. We don't tend to think of that as the term now, but I do think of it as private capital. And so, I'd suggest that those that are seeking capital, you begin a discussion in your head of what are forms of capital.
Yep. And John, when someone comes to you, they are a founder or an owner, and they come to you with the question, like, how do I get capital? Do I need capital? I need capital. Those type of questions. What are those initial thoughts that you have with those owners in terms of the different types and just the different options available to them?
Yeah, absolutely. So a couple things. One, oftentimes we'll talk to founders and entrepreneurs who think of up to David's point, private equity is one thing, that it's a singular actor, that they all think about the world the same, they all think about investing the same. And private equity is not a binary. It's not a binary thing. It's not one thing or another. It's 50 shades of gray. And so the first thing that I do when I'm talking to a founder or an entrepreneur or a franchisor or a group of investors is I ask them what their objectives are. Different stakeholders in businesses have different objectives. Some people want to build an empire. Some people want a quick exit. Some people want to kind of split in the middle, and they've not made any money or created any liquidity for their family, and so they want to take some capital off the table, but they want to continue to own their business. They want to continue to run their business, be involved and make those day-to-day decisions in their business, and so. We start with the end in mind. What are your objectives? What do you want from your business? Is it capital to grow? Is it intellectual capital? Is it non-dilutive capital where you're not giving up a tremendous amount of ownership in your business, but you're sourcing that capital? And then we're attempting to tailor a capital solution that meets their objectives. That's what's most important. And so we oftentimes spend a lot of time with our clients, 2, 3, 4 years in advance, getting to know them, talking to their stakeholders, presenting to their board, spending time with them, just really getting to figure out, in working sessions what their objectives are, and then hoping to pair a financial transaction or some sort of transaction solution to meet those objectives.
In that regard, a term I often use is strategy forms structure, or strategy, right, forms our next steps. I think back to probably 6 years ago, Nick Friedman, one of the founders of College Hunks. Presumably many of you have heard the brand College Hunks. It's over $500 million system-wide revenue now, but at the time came to me, he was probably early 30s, created this brand along with Omar, his co-founder, and said, I want to take some chips off the table. And candidly, I said, why? You're young. You don't, let's be careful. Equity's expensive. That both the person who's providing the equity wants a great return, but it's also expensive to a founder who has a growth business. And I think you got to look at what do you really want to achieve. So I encouraged them at the time, is there a way to take some chips off the table with a non-guaranteed debt facility, do something small, allows you to buy a house for your family, do those sort of things, but maintain the equity. That business quadrupled in size since then. John took it to market on a minority transaction, and they got a valuation that I would venture to say was almost 100 times what he would have gotten 6 years ago. And so something significant. So my point is, too often I hear young entrepreneurs say, oh, I need to do a private equity transaction. And I think what you're hearing is make sure you have a sense of your strategy. And from that, you can surround yourself with some smart people to get to the right answer.
And just real quick on that particular deal, sourcing non-dilutive capital is very, very important to Nick and Omar. They have, and their objectives are, we're going to be $1 billion in system-wide sales, and we don't want to give up that upside. We want to continue to control the business. We want to continue to run the day-to-day. We don't want to take a step back. We just want to, bring on a partner that can help empower us, help us de-risk, get to the next level. So in that transaction, that was a private equity transaction, but Nick and Omar still own almost 80% of their business. They own a tremendous amount of the upside of their business, and they were able to kind of, strike a balance where they can have their cake and eat it too. They can bring on a private equity partner, source the capital markets, but not dilute themselves in a manner that, that limits their upside in the business.
And from an investor perspective, I think that exact case study is the reason why we've tried to be more flexible just as an asset class, where it's not one size fits all. Not everyone wants to sell 100% of their company and go sit on the beach. So we've had to think through our strategy, and if there's a minority investment opportunity in a great business, and traditionally we've only done majority deals, then we're probably going to miss out on that opportunity. So the flexibility and creativity around the different types of deals, whether it's majority or minority, has been very important to, I think, not just Riverside, but other investors in this room.
And David, can you talk about how being a franchisee might be a little different in terms of the question, I need capital, what options are there out there? College Hunks is a franchisor, right? And once they establish their G&A, they can scale up a lot quicker, and they can sell units, and they don't have to necessarily have the capital requirements that a franchisee might, right? Who's putting in the investment for every single unit open. And so it is different for a franchisee.
Yeah, and in the franchisee world, many of us started, with an SBA loan or a privately guaranteed loan, and that you can keep doing that, and it goes so far. But if you want to scale up quickly, and you hear about roll-up strategies, where in essence you're a franchisee, let's say you have 6 units of something, and you decide, I'm really good at this. And in fact, I'm better than most of the other franchisees. I get the secret sauce. And so if I can go buy up other franchisees, by definition, I create value. The problem is each one of those steps of buying up another franchisee and or even building out a unit, even if it's in the services area where you have working capital needs to build units, you're placing capital to work every single time, and you most likely have a defined territory. That immensely depresses multiples. And so the private equity world, or what I'll call the higher end of private capital, who's seeking 20 to 30% returns, finds it very difficult to co-partner, I think, with multi-units, unless you're speaking about just enormous type numbers. And when I say enormous, $100 million type numbers, where all of a sudden the margin makes sense for the entrepreneur. But if somebody's at 6 units and wants to get to 50, where do they go get that capital? Generally, I would say you have to look at your debt markets first. And then secondly, you can look at high net worth individuals and or regional institutional money, small, I'll use the term private equity, but they tend to be maybe a collection of family offices or high net worth within their region that has some affiliation and or reason, strategic reason that they might want to partner with you. But the issue is really about what's the white space, right? Franchisors have this huge white space, and people are paying for that future growth. Very difficult to get that in a franchisee because every step of growth requires more capital.
We are starting to see, some some more private equity activity in backing franchisees. But to David's point, it has to be very large franchisor concepts they're going after. Taco Bell, Arby's, Planet Fitness, concepts like that are proven, that have a track record. And the private equity world is wanting to allocate capital in a consolidation manner. So they're trying to play a multiple arbitrage game. They think, okay, if I can get this to $50 million in EBITDA, then there's going to be a large cap mega fund, a KKR, an Ares, who will pay 18, 19 times EBITDA, or maybe less than that on a franchisee. But for a large franchisee platform, and I can go and roll up some of my smaller franchisees for 5 or 6 times, and generate some return that way. But it's a small handful. It's kind of the top 5% of the franchisee operators that we're seeing that with.
And would you agree, John, not as prevalent in the service industries? It tends to be big, either big box, or maybe said another way, the possibility of, on an EBITDA basis, probably driving $200,000 to $300,000 EBITDA per box. And that's just because you can't get to the numbers they need to get to unless you're dealing with that type of box.
Yeah, that's right.
Off of that, either of you want to just touch on owner-operator and how that plays an aspect too, in terms of how private equity might view a brand and might view an owner-operator brand differently than one that is like an Arby's or a Taco Bell?
Yeah, I think the question, and let me signify this because you see this sometime in services, sometimes van-based businesses I'll use one that's a dear friend of mine, Catherine Monson is the CEO of Fast Signs, right? She does not have a single multi-unit franchisee in the system. Why is that? Because that owner needs to do a whole lot of sales. Secondly, they need to quote jobs. Third, they need to fulfill jobs. And fourth, do customer service. So all of a sudden, if I put that in a manager's hands and say, hey, general manager, go do all these things, that's a really unique individual. Owner-operator can do it. But as soon as you start messing up quotes, right, your margins get destroyed. Juxtapose that to me and Taco Bell. My managers have to fulfill. That's what they have to do. Taco Bell and the brand gets customers in. We have to fulfill. And our margins generally move 100 to 150 basis points if I do it right. So as a result, what you get is some funds, at least on the franchisee side, I believe, have noticed that difference. And so it's another attribute. I think it also is an attribute as we think of growth. If I flip the question to franchisor, and I'm going to ask Steve to maybe comment, private equity is not just looking at what's the EBITDA, and I'll give a multiple of EBITDA. They're looking at what's the growth, how do we get that growth, how difficult is it to get that growth, what's the franchisee base, what's the franchisee success. So maybe just touch on some of those KPIs that you would look at as a private equity investor.
Yeah, so you mentioned it before about the white space. One of the exercises we do when we're evaluating an investment up front is mapping out how many territories they currently have and how many territories they can have in the future. So if there's 50 territories sold now and there's the potential for 500, that's exciting for us that we can sell 450 more territories. So that is a big one. I think a lot of the KPIs were mentioned in the presentation earlier, just around knowing your cost per leads, your conversions, your media mix, your revenue by source. These are all KPIs that we're looking at. And if it's owner operated or absentee owner operated, I think one of the things we look for is that owner operator making a good living? Could you sell that concept to another potential franchisee and say this person is making X and that's enough to live comfortably if they work hard and support their family?
So off of that, I'm going to push back a little bit. So private equity firms like to look at white space, right? What's our growth profile? How much can we grow? Can we take this $10 million EBITDA business to $30 million of EBITDA in 5 years, right? We like to think of doubles and triples. And as you are an owner or deciding when's the right time to either raise capital or sell my business, I think oftentimes you might hear, make sure you leave some meat on the bone, right? And that's sort of what Steve was talking about in terms of what's the growth. I somewhat have maybe I agree with that. I also think that there's something to be said for, back to the earlier comment, if you are an owner and think you can grow this and grow it from a $3 million business to a $10 million business, and you bring on capital or you sell in any way, you are giving up upside, right? And so one of the things I would say private equity is really good at is financial engineering. With more growth and more EBITDA and more cash flow, just cash on the table, I would argue private equity can do a lot more with it. We can make different bets. We can look at different avenues. And so I would caution to be somewhat careful when you hear, oh, you got to sell to make sure that the next buyer has some meat on the table. Because I'd argue that if you execute and then if you grow, and there's capital, a lot of capital at the end of that road, private capital is going to be able to allocate that capital in a way to generate returns. Is that fair to say, John, David?
Yeah, absolutely. Yeah, I mean, look, to me, again, it's all about what your objectives are. Have your objectives in mind, and you can tailor a financial transaction solution to meet those objectives. I mean, when I think about a deal we did last year, we sold a business called My Salon Suites to the Propelled Brands, which is Catherine Monson's new B2B roll-up, multi-brand franchisor, with Fast Signs being the core asset. And Keith McAllister is the founder there. We had a tremendous amount of private equity interest in that transaction as well. But here was Ken's objectives. Ken said, look, I've got 250 units open. My franchisees are doing well. I've not closed a unit. All of my franchisees that have been open for more than a year are profitable. I have a 98% occupancy rate in my system. I've sold a bunch of franchise deals I've sold a bunch of 3-packs and 4-packs, and I can't get my franchisees open quick enough because I'm real estate based. I don't have access to SBA financing, and so the traditional debt market is looking at my franchisees and saying, hey, yeah, pat on the back. That's great. You've got a unit open and you're making money. But we need to see more operating history before we'll lend you more money to open up your second or third unit. And so his objective was, and he posed this to everybody that we talked to in the process, how can you help me get more franchisees open quicker? I can get to 500 units in 7 years on my own. How do I get to 500 units in 3 years? And we had a lot of thoughtful responses from participants and bidders in the process. But ultimately, it was Propelled Brands who created a very creative, tailored solution. They went to Apple Pie Capital. Their private equity investors, Freeman Spogli and Light Bay Capital, committed $30 million more incremental capital for a dedicated franchisee finance vehicle that Apple Pie was able to lever up to $100 million, and now they have a $100 million dedicated pool of capital to fund franchisee growth. And that's going to get them to 500 units in 3 years. And so I know it's a long-winded kind of illustration, but what it proves is that private equity can allocate more capital to meet your objective in a non-traditional manner. It's not just about buying your business for 100% and you going to the beach if that's not what your objectives are. If you have a specific objective and you're open to the market, if you're open to advocates, on your behalf, advisors like myself, and you're open to the capital markets, they can help you create that solution that's going to meet your objectives.
I might just add around this whole idea of strategy. I do think private equity can bring much more to the table than just capital. They can bring strategy, and they can bring what I call intellectual capital. And some of you have heard me speak before. Many founders, franchisee or franchisor, run out of intellectual capital before they run out of financial capital. And that's not to poke the bear. It's just to say to you, having other smart people around can sometimes be really helpful. And so having access to Steve and his team provides the ability for you to see your blind spots that might be inhibiting growth. And so in that light, Steve, maybe offer up what you've seen Riverside do or other, of your competitor firms. How can you help some of these founders continue their growth?
Sure. I think one of the big things is setting up the board of directors and bringing in outside opinions of maybe it's the expertise in the end market, maybe it's someone who's done franchising before, maybe it's David. Giving people access to folks who have done it before is extremely helpful, and that can help a founder get from, if they went from 1 to 100, maybe they can progress from 100 to 500 with the right people. I think the other thing that we try to do is identify rising stars within an organization, and finding someone who's a general manager who has a lot of talent, providing them with the right training, career advice, and helping them get to the executive management team over time and promoting from within. So a lot of it boils down to talent, and the board of directors can be extremely helpful. Even if you're early stage, you can help set up an advisory board of folks in this room, consultants, bankers, franchisees, whoever it might be, to help you think in the right way so you can grow the way you want to and achieve those results.
Awesome. Know there's a bunch of suppliers here, so I'd like to make sure that we touch on you. David, given this large supplier network, how should suppliers view private equity, this conversation? What can suppliers do from a finance perspective to help firms in a way that might be unique or different?
Yeah, it's interesting. As you all know, I'm a franchisee and I'm a franchisor and I deal with many of the suppliers in the room. I'll tell you a question that I would suggest to all suppliers, that when you meet with your respective franchisee or franchisor each year, that one, you have a dedicated top-to-top meeting. This is an industry that I don't see as much of that, candidly. And what I mean by top-to-top is top of your organization. And if you are the top, and you're a supplier, that you're meeting with the CEO, founder of the organizations you serve at least once a year in a very dedicated and intentional way. And then secondly, within that meeting, that there be a discussion of how can we help you create value? How can we help you grow your business? I will tell you 95% of the calls I get from suppliers is them pitching me. And I know we all say we're in a relationship business, but I will tell you the phone calls I get are all pitches. And I firmly believe that the way we help, and I thought this was an appropriate question here at Young Conference, because we, in theory, are helping young entrepreneurs or early stage entrepreneurs grow their business, franchisor or franchisee. And I know we have a large supplier network. I think it's worth just saying, ask the question, how can we help you grow value? And just step back and listen. Because a lot of these CEOs and founders know it, but they don't know how to get there. Like, they can define it, but they don't know how to get from here to there. And the supplier network in this industry is amazing. And you might not be able to service them, but you might know someone who can, and that will come back tenfold to you.
And off of that, in terms of this being a young conference, before we open it up for questions, we'd love to ask John, what is your advice for young people in the franchising industry? Maybe that relates to private equity, maybe it doesn't, in terms of maybe it relates to raising capital. Any just overall suggestions that you'd have for the young audience here?
There's a lot of things to love about this industry as a business model, but the thing that I love the most about it is that we're all here because we share the same business model in common, whether you're a healthcare franchisor or a fitness franchisor or a food and beverage franchisee or you're a vendor to the industry. And what that breeds is collaboration and not necessarily competition. I do a lot in food service outside of franchising, and the food service industry is notorious for talking bad about each other and knocking each other off because they're all there to really take market share from each other. But if you're a healthcare franchisor and you're a residential services franchisor, for the most part, there's a tremendous amount of overlap in terms of what best practices are. That's why we're all here. That's why everything is, the first two sessions this morning have been so relevant to everybody. And so, embrace that, embrace the collaboration within this business model and within this franchising community. That's one, seek mentors, have a mind towards just building relationships, seek advice. And even if you're not ready or if you're early, start talking to capital providers, start talking to advisors like myself, start talking to private equity groups so you can understand what they look for in terms of size, in terms of key metrics. And then above all else, one of the things I'm about to say is something that everybody knows, but the other is maybe not. We're all here because of the success of franchisees. So, always have that in mind. Always have unit economics and the franchisee success in mind. That's the key driver in my business. But what people don't know is that you may have the best unit economics in the world, and if you don't have the metrics and the data to be able to substantiate that in the market, then you may not get the most credit for it. And so, in the most premium valued deals that I've done, we've had data at the franchisor level to be able to substantiate unit economics. And I loved seeing what Josh and Zach put up on the board this morning because they have a mind for metrics. They're telling you early on we're focusing on metrics at the unit level so that we could substantiate that in the future. And I would just really encourage you guys to think about that. And because you're always, to build value, you're going to have to substantiate your franchisee's unit economics in the market.
I would echo that. I would also say to the young people in the room, I know you look back and you say, oh, well, they might have had it easy in the 70s or 80s. There wasn't as much competition. I'll tell you, I think smart people can move faster, quicker today than we ever could. And so embrace it. I love that word about embracing that Michael had. We really need to you need to embrace what this wonderful opportunity and franchise business model is. I would also say reach out. You reach up, you reach out, and you reach back, and you just reach. So Josh and Zach and I have never spent that much time together. FranWorth, in many respects, is what horsepower is. We just do it in health and beauty. They do it in services. We've never spent time together. I went up to them at lunch, and I said, I haven't spent enough time with you. Let's get together. They're going to fly up to Ann Arbor. We're going to spend time together. I don't know where that goes. Might go nowhere. I might engage their digital marketing service. I don't know. Two really smart guys in the room that I haven't spent enough time with. So to the young people in the room, reach out. You just got to reach out to people and say, hey, we haven't spent enough time together.
I don't think I'm qualified to be giving advice. So
Yeah, we still have.
I'm writing all these nuggets down too, and I just appreciate how friendly and open and all the mentors and people in this room are. So that's what excites me about the franchising industry.
I guess you have to lose your hair in order to answer the question. Any questions from the audience?
Sam?
So for private equity and for the investment bank, John, the Fed fund policies in the last 2-3 years have made it easy for the asset bubbles to grow between the markets, stock markets, as well as housing, right? And those bubbles we have to create with all the data are at almost peaks for a long time, go high. And yesterday or the weekend, Yellen said that the first move would be half of that. They're saying maybe 2 this year. I'm estimating personally maybe 2, and probably going into 2023. Premature of what the Fed said they might do 6 months ago, 9 months ago. Where do you guys perceive this market? We've been graciously involved in, regardless of COVID, capital market had boomed, right? Where are we, you think?
Yeah, so to repeat the question, paraphrasing, there's been low interest rates, pretty low cost of capital from a Fed funds perspective. With inflation, they're starting, Yellen is and the Fed is signaling some interest rate increases. Where are we in the cycle? Where do you see the future? It's a great question. Look, I mean, there's a lot of pressures. I mean, it's hard out there. I mean, from labor pressures to commodity pressures to, now cost of capital potential pressures. I think about it kind of 2 ways. I see that as not maybe a long-term something that's going to just kill momentum in the capital markets. And the reason is because you got to think back about, okay, what are the economics of private equity and this private capital? The investors who are investing in private capital are doing so over a 10-year period, and so there's no redemptions. You can't invest in a private equity group one day and then the next day change your mind like you can a stock and sell that stock and get your money back. You're committing capital over a 10-year period, and so it's an illiquid asset, and those dollars have to be put to work. And so from a long-term perspective, maybe over a 10-year period, some private capital fundraising may decrease or stabilize, but that capital engine is going to continue regardless of kind of fluctuations in Fed funds policy. Now, what it is going to impact is access to the debt markets and what the pricing is of that debt. And so all debt, whether it's commercial debt or private debt, is based off of a floating index, and it's typically LIBOR. LIBOR is very low right now, and there's typically a spread over LIBOR depending on where you're getting your capital and what the risk profile is of your business. And so I think that's where you're going to see some short-term fluctuations in the cost of capital on the debt side, and that's going to come into play in terms of how quick your franchisee is going to be able to fulfill their development agreement. Or how expensive is it going to be at the franchisor level if you choose to look at debt capital as one of your potential transactional objectives?
Playing off that economic theme, look, I'm not an economist. Stayed at a Holiday Inn last night, but I would just suggest what I'm seeing currently in the consumer market. My bigger fear is inflation and its impact on discretionary income or discretionary spending. So think through your business. I give you this encouragement, and I don't say this to be a Debbie Downer. I'm saying this, just be thoughtful of your business. The consumer that spends with you how is that spending discretionary? Could they get rid of that service? Could they get rid of that extra meal? Whatever it is. And if they could, be careful and watch what's going on with consumer spending. Some of that will be driven by Fed funds. But the more immediate hit that some of you, and I'm speaking to the young people in the room who haven't seen a recession before, the immediate hit is you got to be aware of what's going on in consumer spending. I'm starting to see fissures in the last 30 days in some of the consumer businesses I'm involved in. If you think about it, you take a family that's making $60,000 to $80,000 a year, and you start pulling out another $100 a week in gasoline and some other inflationary costs, they have to cut spending somewhere. We know Americans aren't living on savings. So they got to cut it somewhere. So I say that for the young people in the room. Watch your consumer spending. That'll be short term. Fed funds and some of those will impact your business on a longer term, but be aware of what's going on with your business.
Well, yeah, the only thing I'll add is we still need to deploy capital, so we'll just have to deploy it more smartly and maybe go deeper into franchising, better understand it, deeper into some of the other areas that we deploy capital. And maybe we have to think about if we're buying at certain multiples today, maybe those multiples aren't going to be there in 4 or 5 years, 2, 3 years. So we really need to be focused on growth and making that company bigger and better, because we're not going to, if we're buying here, maybe we're selling here. So we need to grow.
Well, thank you all. Thank you, panelists. Hope everyone could take a nugget. Appreciate it.